Good morning, Jimmy. How are you doing today?
I am doing well. Jeremy, how are you?
Pretty good. Well, today we're going to be talking about geopolitical risks, and this comes on the heels of those absolutely tragic and awful events that took place in Israel and Palestine over the last few days.
Right.
And we just want to start to say by saying that our hearts go out to all those who have been affected by that, and it's just an awful, awful tragedy.
Yeah, it's an unfortunate reality of the world that we live in.
It is, but it does raise the question of geopolitical risks, and that's what we're going to tackle today.
Yep.
So is the world on fire? And sometimes it feels like it is in the moment. Every year, there are companies, research companies like S&P Global, that look and examine and try to forecast what are those things, what are those geopolitical risks that are going to potentially impact the market, and what's going to be their impact, how likely it is, how impactful it is.
Right.
And so this is a little bit of a chart of what they were predicting at the beginning of 2023.
Yeah, I don't see any Hall of Fame predictors here.
No, it's tough.
It is. I mean, making predictions about the future is very difficult. And when you're looking at things that have such great scale as a true geopolitical event, it's basically impossible to predict.
And one of the things that's consistent is that every year there's this chart that's put out by S&P Global. It's going to be full of data points.
Right.
There is not going to be some of them are going to be the same.
Absolutely.
There are persistent problems in the world. However, there are also flare-up problems in the world that you can't anticipate.
That's exactly right.
So what we want to do is we want to take a measured approach, and by doing so, we're trying to look at this through the lens of data and through some sort of a measurement process. And actually, the Federal Reserve System actually has produced a couple of different papers on this subject where they look at geopolitical risk against an index. And what you're seeing here is 100 is like the baseline. That's the stock and standard baseline, and you're going to see spikes.
Right. Yeah, we have these events. It's these are all really different and unique in nature, but you can see that the 9/11 attack is the highest impact here from a measurement perspective above that 100 index. But what you see is pretty quickly there is a reversion to the mean. So again, you don't take lightly these events that happen. It's just you should not allow them to override your strategy in the way that you allocate your portfolio.
Well said. Well said. And what we don't have on here, of course, is we don't have data that's information that has just become real to us. There's nothing on here associated with the issues and that are going on in the Middle East right now. However, no doubt, if we were doing a real-time assessment, it would be there.
Right.
And again, we don't know how quickly it's going to revert to the mean, but history tells us it does.
That's exactly right.
We wanted to put this in the perspective of the long haul.
Yeah.
Right. So
speaking of history.
Yeah, exactly. So we go all the way back to 1900. This is the long haul for sure. And so here we're getting 120 years worth of data.
This is the whole zoom out concept we've talked about before, right? You looking at, if you zoom in on any of those one events in the previous slide, you're going to see a lot of market volatility in the 12 months around there. But when you have the ability in the context of zooming out 5 years, it starts to become less noticeable. Here we are looking at 120 plus years, and a lot of these things that are massive events look like blips on the radar.
That's true.
And in addition to that, oftentimes some of these blips look like really good buying opportunities.
For sure.
Right? I mean, it's impossible to imagine that in the moment.
Yeah.
But when you have the ability in the context of zooming out, it all of a sudden starts to look like a decent buying opportunity. So I certainly like the trend here, being bottom left to top right over the time. So consistently having appreciation in the markets, but that's not without a lot of tragedy and crisis and mistakes and errors and judgment made over the years.
There's no doubt about it. You can always be worried about these things. It's part of human nature to be worried about these and compassionate about these events, these things that happen. But there's sort of a hard and call it a non-emotional kind of chord that we want people to sometimes strike, which is to say your money has has a long-term bias to it, just like the market has a long-term bias to it.
That's exactly right.
So on that trend, more time equals more positivity. Help me break this down a little bit. Get into, say, the 1 year period, and then go all the way out to the 10-year period.
Yes. So again, as you saw in that, the long history chart there, you'd expect that over longer periods of time, given that we're going from bottom left to top right, that the markets have a positive bias. And so in any one calendar year, we have, it's almost a 3/4 chance that you're going to have a positive market return, just under 75%. So 3/4 of the time you're getting a positive return in any 1 year.
Heck of a batting average.
Right, it is, exactly. But the further you go out, the higher those numbers get, right? So we
Yes.
started at 73% for 1 year, and just adding an additional 2 years, going up to 3 years, now you're at 84%.
Right.
These numbers are highly skewed in your favor, right? Not a lot of decisions come with the when you're thinking from a probabilistic perspective. Not a lot of decisions you make, do you know ahead of time are perfect, 100% chance of working out. A lot of times you're thinking in relative percentages here. And if we're looking at an opportunity where 84% of the time over 3 years we're going to have a positive return, I feel pretty good about that.
Right.
You get up to 5 years and you're just short of 90%. And then you move it all the way up to 10 years and you're at 95% basically. Right. So now you're talking about some massive statistical advantages there. And so we need to have the time to be able to endure the volatility in the interim. But if you have the time horizon and the ability to weather the storm, well, it's paid off very nicely for you.
That's right. And when we sit down with clients and we talk about the heartbeat, the center item of everything, it's that financial plan. And oftentimes we go back to that financial plan, and it's interesting to see that taking no risk is taking more risk.
Yeah, absolutely.
And so for those people who are proverbially putting their money underneath the mattress, those folks actually are under a much more greater risk than these geopolitical risks pose at all.
No question. Yeah, this is history tells us it's not a great time to sell your stocks and wait for more docile times in the world to invest. I think the numbers speak for themselves. The longer the time, the more opportunity for return.
Okay, that's all we have today, folks. Thanks again for being with us.